The Purpose Tax Bill would increase the child tax credit and restore critical research and development deductions. Dive into the latest Tax Insights podcast as Jeff unravels the complexities of a new tax bill that could impact your 2023 and 2024 taxes.
Well, it's tax season, my friend. I would imagine that you guys are starting to get really busy, aren't you?
I think the floodgates have broken.
Well, have a great season, as they say oftentimes. Hey, Jeff, on today's program, there's a new tax bill that has it been signed into law yet?
It's not. So it's still in the relatively early stages, but it's something that looks like this one, in comparison to some others, might actually have some legs.
All right, because I know that you and I were talking before the show, but this is impacting, obviously, 2024 taxes and potentially 2023, even if you haven't filed yet?
That's the fun part about being in public accounting, Terry. They change the tax rules as they go, even if it's for last year.
So, I'm just curious, how would it impact 2023? Let's say you already did file, but now that this new tax bill takes an impact, what happens in that situation?
Yeah, so in that case, you almost have to amend that tax return. And as we think about this, this tax bill may even go as far back as 2022. So there may be a 2022 amended return that needs to be done if you want to take advantage of some of the provisions of this potential new tax bill.
All right, so let's talk about that, because I know that there are 3 provisions on this tax bill. Walk us through them.
Yeah, the first one is on the research and development expenses. Now, in the past, when a company kind of developed a new product or a new process, in many cases, they were just able to write off those expenses in the year that they incurred them. So, from 21 and before, if you had a $10,000 bill for putting together a new process, you could write that off in 2021. Well, the rules changed in 2022. And the rules changed to say that you can't write that off anymore in 2022. You have to write that off over a 5-year period. Now, the company still gets a tax deduction. They just get it at a much slower rate.
All right. Why would they do that? Like, why would they try and say, hey, we have to do it over a slower period? What's the benefit to that?
Some of it is just pushing taxes into the current year and kind of pushing those deductions down the line. That's really the biggest thing.
Okay.
But you know what this tax bill did? This tax bill said, what that whole thing about 22 and capitalizing and writing it off, maybe we were just kidding. So the new tax bill that they're actually proposing says, hey, even in 2022, if you want to write those expenses off in the first year, you can do that. But of course, as we just talked about, everybody's filed their 2022 return already. So that would require an amended return in order to fix that.
Got it. You said that there are 3 provisions. That was the first one. The second one I know is bonus depreciation. Walk us through this.
That's it. So for bonus depreciation, in the past, we've always been able to depreciate, 100% of an asset via bonus depreciation, which means that if you buy a new piece of equipment this year, you can write off that whole piece of equipment in the first year.
Makes sense.
Now, the rules changed for that. In 2023, they said, no, we're only going to let you write off 80% of that, and the other 20% has to be written off over a 5 or 7 year schedule. Well, of course, this new tax bill comes along, and the proposal says, we were just kidding about that too. Starting in 2023, if this tax bill goes through, you can once again write it all off in the first year. So, fun stuff that we have to deal with.
Sure. And the last one that we want to talk about, obviously the employee retention credit. Walk us through this one.
Yeah, so we've talked a lot about the employee retention credit and about the fraud and everything that went on with that. So, when you have a new tax bill, you have to find a way to pay for it. And the way that the IRS or the way that the government decided to pay for those other 2 tax breaks is by potentially cutting off the employee retention claim credits as of January 31st. Now, you had until April or until next year in order to get those filed, but the IRS said, there's so much fraud out there that we're going to cut that off here as of January 31st. So we'll see if this all comes to fruition, but that right now is what the proposed tax law says.
Sure. A lot of great information here on today's program. Jeff, how would our listeners reach out to you guys? I know that this is your busy season, but obviously if people have questions or would like to connect, Hawkins Dash, where do they go?
I would go right to our website, hawkinsash.cpa, and go to that CPA HQ section.